In this video, we're going to be uncovering some of the big misconceptions or questions or maybe concerns people have about life insurance or when we talk about max funded, overfunded life insurance. Usually, when we make videos on that, we get quite a few comments, and a lot of them are negative. A lot of them are from people that mean well and have really good questions, or maybe have been taken advantage of in the past, or have just heard that life insurance is the worst place to put your money. And so they're obviously letting the world know and saying, hey, like, this is horrible, or asking questions. And so one of the things that I want you to know is, as a company, we're dedicated to helping people live more intentionally. That's why we make videos on business and personal finance. And we've been requested to do more content as relates to life insurance. And so we're dedicated to that. You're going to see more content as it relates to life insurance on this channel. And we've also created a whole nother channel as it relates to life insurance. Like, we want to be the one-stop shop for every life insurance decision, but I don't necessarily want that all to be on this channel. And so if you are want to learn more, want to learn, everything there is to know about life insurance, or maybe are an advisor that wants to learn how we have conversations, you can subscribe to our And Asset channel down below, where we're going to be posting a ton of content. With that said, let me get into some of the big misconceptions that people have as it relates to life insurance. And a lot of these misconceptions are actually good. And so I'm going to be highlighting kind of doing my best to do pros and cons. So the first thing is, a lot of people say, life insurance is a horrible place to put your money. You have zero cash value in the first years. It's horrible growth. The agent gets a ton of commission. Those are a lot of talking points that are said. The death benefit stays level, and they steal your cash value when you pass away. Those are a lot of popular things that people say. And all I will say is, there's forms of truth in those statements, because when you just say something like life insurance, there's a million different ways to go about a life insurance contract. The way that we design life insurance is we're doing what's called max funding or overfunding, or some people call it fully funded life insurance. And as a result, we are literally maximizing the cash benefits, what we call the living benefits. We're minimizing, in most cases, the permanent death benefit, which creates better cash growth. Death benefit, actually, it grows in a lot of cases faster long term because of it's optimally designed. The commission is 1/10 of what it would be in a normal circumstances. It creates way more flexibility, and all those things about they stealing your cash value, or horrible growth, or no cash value in the first couple of years, or level death benefit. All those things are not true when it comes to that. And so, obviously, in this channel, we're not defending the industry. We're not defending bad practices. We're just literally sharing, like, that is why we have this channel. That is why we're unique. And that is why we work with people all over, is because I do agree with you. If you're not going to do this properly, life insurance can be a horrible place to put your money. So that's the first thing that I want to address. And we have plenty of videos that go through a deeper dive on that. And in our new channel, we're going to go through a lot of numbers as it relates to the pros and cons of properly structured life insurance that's overfunded, and maybe something that's traditionally built, and you'll see the massive difference. The second thing that I wanted to address is the growth component. A lot of people will say life insurance is a horrible place to invest your money. It's a horrible investment. The growth is really bad. And there's a lot of truth to this. Life insurance is not an investment. I would never tell someone to invest their money into life insurance. And the purpose of me putting my money into life insurance is not for the yield solely, because we call it the and asset, because we teach our clients that it's a great place to store your capital for some of the benefits I'm going to get into, but you also have control and the ability to use it throughout your life. And so when we compare life insurance, we're not comparing it to an investment. You can't legally call it an investment, really comparing it to other like assets that you can store your capital in. And so this could be like a CD or a savings account, or maybe like a safe bond portfolio, anything that you have liquidity, but also feel comfortable saving your money. There's benefits, like there's creditor protections, and each state's a little different. And there's a lot of other benefits as it relates to life insurance that needs to be factored in. And so when you factor that, life insurance only gets a growth rate of 3 to 4% internal growth. And so it's, again, not an investment, but better than most savings accounts. In fact, at the time of this recording, I don't know of another liquid account long term that's getting anywhere near that. But that 3 or 4% is a tax-free growth rate if set up and used properly. And so we would have to factor in taxes on that. And then you have to factor other things that are built in, like the fees, because there's no additional fees on top of, like, the internal rate of return shows you the actual cost of insurance, which is the drag to your cash value. And so when we start adding in the taxes and fees and the cost of buying term insurance, if you want to do buy term and invest the difference, now we're seeing anywhere from 6 to 7 to sometimes 8% that you have to earn every single year just to compete with the growth of life insurance. And remember, life insurance is not an investment, but when people understand that about how to use that asset, that's a pretty great growth rate. Now, I'm not saying that life insurance earns anywhere near 8%. I'm saying in an alternative account, in a savings account, if something that you want to have the control of your money, you would need to earn that just to keep up with life insurance because of the benefits. And so that is one thing that I just want to address from the standpoint is I want to agree it's not an investment, wouldn't put my money in there to grow, but it's a pretty amazing growth vehicle if you understand that it's just a place to store capital and how to use it. The other thing or question that people will ask is, why would I borrow my own money? Why would I pay interest to borrow my own money? It's a great question, and it's just false. Like, you're not borrowing your own money, you're actually borrowing against your money, and you're using the insurance company's money, and you're getting all the benefits of life insurance. So it's not like a 401k where you're borrowing from yourself or you're withdrawing from yourself. Your money's able to continue to grow. Another question that we'll get is, all right, if that's the case, why would I borrow at like a 4 or 5% rate if my cash value is only earning 3%? That's another really, really good question. I have an in-depth answer to that. But in short, you wouldn't want to do that mathematically. And so it really comes down to a couple things. Number one, your money's growing the rest of your life. But number two is you can't just compare life insurance with just the internal rate of return. There's all these other benefits. And so the truth of the matter is, if life insurance doesn't give you a greater benefit than your cost of borrowing, then you shouldn't do it. Majority of our clients that work with us see that when they start adding up all the benefits of the multidimensional asset, it becomes way greater than the cost of capital. And a lot of our clients will use a third party lending to even get the borrowing cheaper. But I just want to address that because mathematically, if you're only earning 3% and you're paying 5, not a good deal. But overall, there's so many other benefits and there's so many other factors that need to go into. And the big thing that we talk about is results. If you can get a better result with a product, with an asset, that's good. If you can't, it doesn't matter what the product has. It's not a good win. And that's ultimately why we talk about this. Another question that people have is life insurance. Like, it's good for you when you're working, but it's horrible in retirement. There's so many studies. Actually, Ernst and Young just came out with a white paper that pretty much talks about how life insurance can actually be an enhancer to your retirement. And so think about it not as like you putting all your money in life insurance, that's good, but life insurance can enhance your stock portfolio. It can enhance your pensions. It can enhance your annuities. It can enhance options for the future. And it's just one of those things. Again, we ask the question: can life insurance increase your success for retirement? And really, retirement should be future cash flow planning. And in many cases, a lot of clients have more options and can create more income in retirement if they have life insurance, even if it's playing as a bond alternative. And then there's other questions as it relates to, the there's so many other questions I could get into, but those are like the big ones. Obviously, most people understand that life insurance is great for when you pass away. It's great for your estate. And a question that comes up, especially in the Dave Ramsey camp, is pretty much saying, like, Caleb, I heard that life insurance steals my cash value when I pass away. And again, I addressed this a little bit earlier. But the way, if you overfund, if you max fund a policy, each year what you contribute, majority of your money is going to what's called paid up additions. And those paid up additions are buying additional one-time life insurance. And so, to try not to sound super technical, when you pass away, you're only getting the death benefit. And that death benefit gets passed on income tax free. It's a huge benefit to estate planning, and there's a lot of reasons why it's done. In a traditional typical policy, your death benefit might be level. But if you overfund each contribution that you're funding, the death benefit increases. And in majority of cases, your death benefit's increasing way higher than what you're contributing. And so while it's true that you're only getting the death benefit, your death benefit is greater than the original plus what you've put in. And so hopefully that makes sense. With all that said, thank you for watching. If you have additional questions as it relates to life insurance, I would love to hear from you. Please ask them below. We're going to be way more intentional in creating content on this channel as it relates to life insurance. And again, we have an and asset channel dedicated to all the ins and outs and super technical questions when it comes to life insurance. I hope you have an intentional rest of your day.